Welcome to Investment 360. In the hot seat this evening, Paul Stewart from Plexus Asset Management. Paul, a pleasure having you on the show this evening. We're talking about the enhanced index tracker that you manage this evening, and perhaps we need to take a step back and, if you can, in lay terms, explain your methodology.
Great. Well, good evening, Bronwyn. The traditional means of putting an index together uses the method of market capitalization, i.e. the number of shares outstanding multiplied by the share price to weight the stocks in the index. And most of the main global indices that you can think of, the S&P 500, the FTSE in the UK, the Nikkei in Japan, the DAX in Germany, and obviously most of the index series of the JSE are weighted by market capitalization. A company called Research Affiliates looked at the methodology, noticed that it had some intrinsic flaws in it, and looked at another way of creating an index using 4 different accounting measures and creating a portfolio that you can implement like an index, trade like an index, but the weights of the stocks are don't use the share price as the weighting methodology. So we get a portfolio that looks more like a traditional actively managed portfolio, but it's implemented and traded as a normal index fund would be implemented. And the costs are therefore lower than a traditional active portfolio.
So Paul, am I correct in saying there's no manager input, there's no analysis from a qualitative perspective about what stocks you're buying or why? It's purely a computer essentially has a look and analyzes the numbers and buys the portfolio and rebalances that accordingly?
That's correct to a great extent. We don't have a relationship with the company management at all. We don't forecast earnings at all. We simply take numbers out of the income statement and balance sheets of companies. We look at turnover or sales, book value, dividends, and cash flows. We weight those 4 factors equally, and we create an index using the stocks that actually are showing the best fundamental weightings based on those 4 factors. So you actually get an index that's really a value tilted index relative to what would be a normal market capitalization weighted index. So yeah, you're quite right. There's no active management per se, but there is a different and well thought out methodology in terms of how the stocks actually are weighted in the index.
Do you see extensive churn in the portfolio?
No, and that's actually one of the main benefits of the enhanced index versus a traditional active portfolio. A market cap weighted index, you would expect annual turnover of about 10%. We find that in the enhanced RAFI index, which we manage, our turnover is around 25% per annum, sometimes a little bit higher, but that's the turnover that we target. And in many active portfolios, the turnover can be anywhere between 80 and 300% per annum, depending on how active the manager is. So our turnover, transaction costs from turnover is significantly lower.
And Paul, what would be the major high-level differences between your portfolio and the JSE Top 40? For example, someone buying Satrix, so what's been down-weighted, what's been up-weighted, what are the sort of major benefits or selling points?
Okay. The major differentials, obviously, the top 40 index is very skewed towards a couple of big commodity stocks, and the top 10 weights probably 50 to 60% of that index. So what we tend to find is that our index is more skewed towards the slightly smaller of the large cap stocks and slightly skewed towards the mid cap stocks if we look at the all-share index in its totality. So you would find, I mean, just to give you an example right now, the Billiton is our biggest single position, but its weight in our index relative to its weight in the top 40 is quite a bit lower. We're in there at 12%, and I think it's in about 16% in the top 40 index. Our next biggest stock is Old Mutual. And we've got Old Mutual in at 5.9%, nearly 4% over its weighting in the index.
Paul, before we move on from Old Mutual, how long have you been in Old Mutual? I'm trying to find out whether you enjoyed that 12% kicker we saw recently in the stock.
Yes, we did. It brought great jubilation in the office. We've actually had Old Mutual in the portfolio for quite a while, and actually its weighting in the index, based on its fundamental factors, has been gradually increasing over the last year. And it was one of the stocks that when we went and saw boards of trustees and talking to professional investors, it was quite a difficult one to justify in the portfolio. And then obviously the announcement in December, and I suspect some more announcements that may be made in the future, have had a very positive effect on the share price. Up what, 30% since September of last year. So yes, it's been in the portfolio for a while, and it's the kick to the portfolio over the last 2 months has been quite significant.
Interesting to note that of the banking stocks available out there, only Standard Bank is in your top 10. Any particular, well, obviously it is done on relative calculations, etc., but fundamentally, if you were to look at Standard Bank, would it also be one of your top picks?
Yes, and I must say that in the weighting scheme of the index, there really isn't that much difference between the banking stocks. It actually comes down to decimal points. But Standard Bank happens to be the best stock at this particular point in time. It's certainly not consistent through time, and when we reweight the index again at the end of March, it could be first round. We've actually had each of the 4 big banks as the biggest banking weight in the index over the last 2 years. So there's nothing specific about Standard Bank at this particular point in time, other than on the 4 factors that we use. It appears to have the best fundamental criteria out of those 4. But as I say, there's nothing magic about that. And I wouldn't be at all surprised to see in the next quarterly rebalance, which would be in March of this year, to see positions changing once again.
Paul, with all the uncertainty out there that we keep referring to over and over again on this show, what are your thoughts on the general market environment, particularly in South Africa?
Bronwyn, I wrote a piece at the beginning of the year, putting my neck out there, really describing what we thought the expected return environment for the year would be. And we looked at various different factors, and our nominal return expectation for the equity market came out at around 11%. And that's really informed by a couple of things. We think that commodity stocks are, relative to the historic past, looking quite cheap. We think banks and financial stocks are still relatively cheap, and then we think that there's certain aspects of the industrial market that have had fantastic runs. The retailers that have had fantastic runs and are looking pretty expensive in our estimation. So I think there's a pretty mixed bag out there, and I think stock selection is going to be a very important aspect. Unfortunately, you've got this global environment which really is on a knife edge, and we're really applying 2 different scenarios to what happens in Europe, because we think that what happens in Europe will really determine what happens in the rest of the world, and if we have an unruly default and a breakup of the European Union, there's certainly no way, no matter how good the valuations of the local market appear to be, that we will go through that unscathed. So locally, we actually think that valuations are okay. They're not bargain basement cheap, but they're certainly in some parts of the market, valuations are reasonable, and growth is going to be reasonable. So we actually are happy to hold equities, but there's this nagging risk out there the whole time that some factor beyond our borders could have an impact on risk. Foreigners will, the risk off trade will occur again, the rand can weaken again, and all those things, and it's really so difficult to predict because we've got zero control over that.
With that nagging risk out there, just looking at the factors
that we can control, we think that the South African equity market should deliver reasonable real returns this year, around about 5%.
With that nagging risk out there, what's your standpoint on gold as an insurance policy?
We've, I think Bronwyn, we've been very positive on gold for quite a long time, and we've had exposure to the Absa New Gold Fund in our portfolios for some time, and we still have it there. It hasn't performed particularly well in the last 3 to 4 months of the year last year, but we still think that the gold price is on the way up. We think that quantitative easing, and I see that the Bank of England has just announced another £50 billion today. We think that this support of the financial system and the banking system in Europe and the UK and the US is going to continue, and we think that those developed market currencies are going to continue to trend weaker over time, over this sort of secular time frame of the next 2 to 5 years. And as a result of that, we still like, gold and other commodities similar to that, precious metals and oil. So yeah, I'm still positive on gold, and we still have some in our portfolios.